The 1929 panic erased 86% of investor wealth, 2008 torched $8 trillion, and the dot-com implosion vaporized $5 trillion more. Yet the sharpest players weren't blindsided at all. They read the warning lights, shifted their money, and walked away richer while everyone else counted losses. How did they spot the danger before the sirens? What do they know that we don't? In this video, we will understand how they see these signals months before. And if you can learn to spot those signals too, and act while everyone else is still cheering, you will not just survive the next slide. You may come out of it wealthier than you went in. So listen closely, because the market is starting to whisper the very words that always echo before the floor gives way. And you will notice it, especially after the fourth whisper. The first whisper is euphoria, the stage when ordinary people behave as if prices can only rise. During the Florida land boom of the 1920s, strangers bought houses they had never seen with loans they could never repay. In 2007, waiters bragged about flipping 3 condos on no-doc mortgages. 2 years ago, your barber might have shown you screenshots of meme stock gains or a cartoon monkey JPEG worth more than his car. You know euphoria is peaking when your social feeds fill with overnight millionaires, when every dinner guest is all in on a single hot idea, and when you feel embarrassed for not joining the party. That feeling is delicious and dangerous. The moment you notice it, promise yourself you will not chase anything that has already doubled in a month. Wealthy investors love these frenzies because they give them willing buyers for old positions. If you sense euphoria, glance at your own holdings and trim the outsized ones so you are the seller, not the buyer, when the music stops. The second whisper is valuation that no longer makes sense on a calculator. In the late 1990s, an online pet food store with no profit became worth more than Delta Airlines. In 2021, unproven electric truck companies reached market caps larger than Ford. Today you can still find stocks trading at prices that assume revenue will rise tenfold without a hiccup. A quick gut check is the price-to-earnings ratio. If a company earns $1 for every $600 of stock price, the math says investors are paying for 6 centuries of profits up front. That is not an investment. It is a bet that someone even more excited will buy it from you later. When whole sectors sport ratios that high, history says a reset is near. The solution is not to sell everything, but to make sure your core money sits in businesses that can justify their tags with actual cash flow. When a correction hits, those firms drop less and recover first. The third whisper is tightening money. All bubbles need cheap cash, and every crash starts when that cash dries up. Look back. Before 1929, the central bank raised rates from 3 to 6%. Before 2000, the Fed hiked 6 times in a year. Before the 2008 crisis, credit conditions had already tightened for 18 months. Rising rates make mortgages, auto loans, and corporate debt more expensive. Companies that borrowed short-term must roll that debt at higher costs, eating into profit. Consumers who lived on zero-interest credit cards suddenly shrink spending. The bathtub analogy helps. The faucet is the Fed pouring water into markets. The drain is normal bills pulling it out. Tightening is when the Fed turns the faucet down. Water, or liquidity, falls, revealing problems nobody noticed when the tub was full. You can track this at home by glancing at the money supply chart labelled M2. When the line flattens or drops and the Fed talks about higher for longer, the stage is set. Defensive moves include paying off, adjustable rate loans, locking in fixed mortgages, and keeping a cash reserve for bargains. The fourth whisper is stress in credit markets. Tight money exposes weak links, a hedge fund that used too much leverage, a property developer swimming in floating rate debt, or a corner of derivatives nobody watched. In 2008, it was subprime mortgage bonds. In March 2020, it was corporate debt sold to yield-hungry investors. You will not predict the exact domino, but you can observe cracks, spiking yields on junk bonds, failed auctions of treasury bills, or a once-respected fund suddenly limiting withdrawals, all hint that someone lacks cash. Smart money sees these cracks and quietly builds protection. You should do the same by trimming margin, refusing new leverage, and diversifying into assets that do not move in lockstep, short-term treasuries, gold, or even plain cash. The fifth whisper is rising volatility. Markets rarely fall straight down from calm highs. First, they start swinging like a loose door in the wind. Big up days, followed by equally big downs, then new highs that fade by lunchtime. In 1987, the Dow moved 1 or 2% a day for weeks before Black Monday. In late 2019, the VIX crept higher, months before the pandemic crash. You can watch the VIX index yourself. A steady climb from low teens into the 20s, while prices are still near records, tells you nerves are fraying beneath the surface. If you own positions that rely on calm conditions, like naked option sales or highly leveraged ETFs, consider scaling back when volatility smirks at you. The cost of optionality, such as put options far below current prices, is cheapest before panic spreads. A small insurance premium can buy enormous peace of mind. When those whispers overlap, euphoria in the news, sky-high valuations, tighter money, credit cracks and whipping volatility, history says the spark could come from anywhere. A political crisis, a surprise default overseas, even a natural disaster. The exact trigger does not matter. The tinder is ready. So how do you turn warning into action without swerving off the road? First, build layers instead of flipping a switch. Keep your core in broad index funds, still the cheapest way to own human progress. But rebalance so no single sector dominates. If large tech ballooned to half your portfolio, trim it to a third. Use the proceeds to boost unloved areas such as healthcare, utilities, or short-term bonds. You are not timing the market, just respecting risk. Second, maintain dry powder, cash equal to 3 to 6 months of living costs, plus a little extra labelled opportunity. Cash feels pointless when stocks surge, but during sudden slumps it buys assets at 50-cent dollars without forcing sales of your favourites. Think of it as oxygen. You barely notice it until the room runs out. Third, consider a disciplined hedge. Buying put options on the broad market 3 or 6 months out is like homeowners insurance. You hope it expires worthless, but if a storm hits you, collect cash while neighbours scramble. Allocate only a small percent of the portfolio. The goal is to cushion, not to gamble. Fourth, test every position with a simple question. If it fell 30% tomorrow, would I add more, hold, or lose sleep? Sell anything that fails the test, because panic will rob you of better judgment. Finally, automate new contributions. Crashes are brutal for emotions and fantastic for math. By dollar cost averaging through fear, you gather more shares just when valuations normalise. Every great investor you admire, Buffett, Templeton, Lynch, made their largest fortunes by purchasing when prices looked scariest. Will these steps prevent paper losses? No market strategy erases temporary red ink. The aim is survival and optionality. In 1929, the people who kept cash and avoided margin later bought blue-chip stocks for pennies. In 2009, disciplined investors picked up quality companies at single-digit price-to-earnings ratios and watched them triple within 5 years. In 2020, those who held their nerve doubled accounts as stimulus and recovery lifted everything. Remember, crashes are not punishments. They are transactions. Wealth passes from the impatient to the prepared. You do not need to predict the date, only recognize the familiar setup. Wild optimism, silly prices, tighter money, credit tremors, jumpy swings. We are not at full alert yet, but several gauges are flickering. Euphoria appears in pockets of artificial intelligence stocks and certain cryptocurrencies. Valuations on a handful of story companies imply centuries of flawless growth. Interest rates remain high, and minor bond market glitches have already made headlines. Volatility has started to twitch, even while the S&P sits near highs. These may settle down, or they may converge into the next storm. Either way, the checklist is in front of you, and the clock is counting. Take 10 quiet minutes tonight. Rebalance, raise a bit of cash, and if you wish, price a small hedge. Write down the signs you will watch and the actions you promise to take before screens turn blood red. Pin that note beside your desk. If panic comes, follow the script and remember that history rewards the investor who keeps a level head while crowds shout. The smart money is already preparing. Now you know what they know, and one move that any smart money person would make right now is to subscribe to this channel, to stay always updated on similar issues and to understand how to emerge victorious from these crashes. Let me know what you think in the comments, and if you liked the video, leave a like for more similar content in the future, and I'll see you soon.